Good afternoon, everyone. Thank you very much for joining us. This is Startup Finance's Q&A number 9. It's our 9th monthly session. This is for UK startups only. And the idea, it's quite simple. 90% of startups fail. The top 3 reasons for that are 1, market fit, 2, running out of money, and 3, not having the right people. But guess what? As most startups that I've met, most founders I've come across, most of us struggle with finances, which is why I've got 4 amazing panelists with us today. They're going to be with us for the next hour. Perfect. So here's what we're going to do today. We are going to have some quick introductions. Then I'll be asking my panelists for one do and one don't when it comes to early stage finances, and then we'll open it for questions from the audience. The way this is going to work is that for those of you who are on the live streams, whether that's LinkedIn, YouTube, Facebook, or Instagram, please be aware that unfortunately we are unable to monitor your questions there live. So if you do want to ask our panelists anything, you'll have to join us here on Microsoft Teams. It's audio only, which means you can tune in from anywhere via any platform or device. Quickest way to get here, it's either to go onto our website, startuptoscaleup.club. So again, it's startuptoscaleup.club. Scroll down a little bit. You'll find today's session is Startup Finance's Q&A 09. You click join. It's a quick registration on Luma, and then you'll be able to tune in here. And because it's audio only, you can tune in from anywhere via any platform or device. Now, in terms of questions today, there are no wrong questions, and there's no need to be shy because it's a learning curve for us all. Your questions can be on anything to do with startup finances. So whether you want to know about cash flow or budgeting or profit and loss, or maybe payroll, bookkeeping, VAT, auditing, loans, banking, projections / forecastings, and all that jazz, really. This is the place to ask it. Now, we're only going to be here for the next 55 minutes, and my advice is not to leave it for last second, because then we'll run out of time, and as often happens, we are then unable to answer any of your questions. Now, without further ado, I'll start. My name's Anton Cole. I'm an Albanian in London working with startups. Normally, right after they get investment, I embed within their teams and try and keep the right people. I also do some growth advisory work with a few other startups and accelerators, and I help some angels and family offices with their due diligence and assessment.
Hello, I'm Harriet Formby. I run my own fractional CFO practice below the line finance. I've got a background in kind of financial strategy, 15 years across sort of startup scale-ups and finance transformation in a range of sectors, including sort of private equity, not-for-profit, multinationals. But I spend a lot more of my time these days on sort of tech and more creative sectors typically. And I have a particular focus around sort of mission-driven businesses, but the usual range of things, cash flow difficulties through to growth strategies from sort of pre-revenue all the way up to quite established businesses. So yeah, really good to be here as ever.
Hi, I'm Andrea L. Richards. I run an accountancy practice called Account Navigator. I've run this practice for the last 23 years. Me and my team specialise in management accounts, and we run a virtual finance office where all our clients basically take over their full account function, run the accounts department, but we specialise in understanding your figures so that you make the right decisions to move your business forward.
Hi, I'm Sophie Wright. I'm a fractional CFO and founder of Wright CFO, which is a firm of fractional CFOs. We've been going for 11 years. We're a team of 9 at the moment and growing. We specialize in tech, creative, media, and not-for-profit businesses. And although we do CFO services, we also have kind of fractional financial controller, and do things like partner with other businesses that do kind of finance related kind of IT migration, stuff like that. Thanks for having me.
My name's Samuel. Managing partner of Arthur Hamilton and ScaleUp CFO. I lead a team that supports founders across the UK, Europe and US and Africa, helping them to scale profitably through financial clarity, cash flow discipline and better decision making. I specialize in turning fast growth but chaotic business into financially strong, investor-friendly companies. I'm excited to be here. Excited to be here once again with very familiar faces on the panel.
StartUptoscaleup.club. And what would you say is one important do and one important don't when it comes to early stage finances? And let's not use the same reasoning or logic for both, please. So
Sure. Okay. So my do would be to make sure that from the outset you set up some sort of financial system as a priority and get onto software and engage with an accountant as soon as possible, just to sort at least the basics out so you know where you are. And my don't would be to be afraid to ask lots of questions, because especially if you're new to managing business finances, things like this are a brilliant opportunity to ask any and all questions.
My do would be, and I say this every time, is definitely register with an accountant from the very beginning. Important to do that from setting up your business, so that you set up the business correctly with the right share formation and stuff, and decide what legal entity is best for you when you set up the business. My don't listen to Dave down the pub. Yeah, go to a qualified accountant who can actually give you the real facts. Don't listen to Dave.
My do and my don't are around cash and preserving cash in your business. So my do is to do things that will help you get paid by your clients faster. So that could be whether it's a subscription, get them to pay by direct debit, or, you can offer discounts to pay within 5 days instead of, or pay the full price in 30 or 50% up front. There's a lot of different things you can do. The idea is to get paid quicker and pay your suppliers slower. And then my don't, another thing to do for just preserving cash is if your business is one that has inventory or stock, there's a fine line. You need stock to be able to sell, but a lot of businesses go under because all their cash is tied up in stock and there's too much. So carry enough stock that you have to sell, but not too much, so that you can keep hold some of your cash.
Fantastic. So I'm actually just giggling from Dave at the pub joke. All right. So my first, I'll start with a don't, and it's don't treat your bank account like your personal wallet. I would advise that you pay yourself something consistent, even if it's small, and it keeps the business finances separate. I think it's very important you do that. Most early stage startup companies get into bad habits and they treat their business bank account like their personal wallet. So something you need to kind of refrain from. And a do is a simple 12-month cash flow forecast in place. Just have it in place for your business. It doesn't need to be fancy. It just needs to be clear view of what's coming in and what's going out, and how long you have or how much cash you have left in the business. Most founders make better decisions the moment they see the numbers in front of them, how much they have in front of them. So those are my do's and my don'ts. Thank you.
question is as follows. So this is about modeling corporation tax for startups with losses. She says they're a green tech startup developing algae-based biofuels, location Newcastle. And then she goes on to say, the challenge we have is that our company has significant operational losses due to high R&D expenditure, and we're unsure how to model future corporation tax liabilities when profitability will be projected. The situation is that we're a pre-revenue funded mainly by grants and some early stage investors. So again, the question is, as a green tech startup with significant operational losses, how can we integrate future corporation tax liabilities into our financial models whilst factoring in carry forward loss provisions? Also, what UK specific rules, such as allowable offset or losses against future profits and compliance with HMRC loss relief regulations, should we incorporate to ensure accurate projections, tax efficient planning?
Hi. So I think some of the others on the panel are going to be more knowledgeable than I am on the specifics, especially if they're practicing accountants. I know you can
Sorry to
offset.
interrupt, Sophie. I'm really sorry. Just one thing. If you don't feel like it's your bag, don't worry about saying pass. It's totally fine. We're not
okay,
meant to know every question thrown at us.
Okay. I was just going to say, I know you can bring forward your losses in your first year of profitability. If you've had losses in the previous years, your tax liability is going to be negligible because you can move forward. There is a limit. I don't want to, it might be 4 years or 3. I'm not entirely sure. I think the rest of the panel probably know the rules, but I know you can bring it forward, but I'll leave it at that.
Yeah, this is a classic early stage deep tech problem. So I believe what they're saying, they're burning a lot of R&D, your miles off for revenue, and you're wondering what to actually do with corporation tax in the model. The first thing I'd advise is treat losses as an asset in your model. So even though you're not paying corporation tax yet, as was previously alluded to, every year you're building trading losses that you can use to shelter future profits. So in the model, I'll have a simple loss and tax schedule that does this each year. What you would do is start with losses brought forward. You can add the current year tax adjustment losses as well. And when you flip into profits, you use those brought forward losses to reduce the corporation tax bill, right? That's number one thing I do. There's other things you can also do as well. You can build into your build in the key UK losses rule, and at a higher level, basically what it is trading losses can be brought forward and used against future profits. And don't also forget the R&D angle as well, because you're a green tech startup with heavy R&D as well. So while you're making losses, you may be able to claim R&D tax relief or credits, which can either increase your losses or convert some of those losses into cash back from HMRC. Thank you.
Yeah, all I'd really add to that is just at a high, it's quite a detailed question. At a high level, I'd say yes, there's depending on dates and things, possibility that you'll get a credit back. In terms of sort of two sorts of modelling, I guess. If you're modelling for sort of like viability and general like business trading as you get going, then obviously start to assume that there'll be a corporation tax bill. If you're modelling sort of 5-year models, I'd say do a little calculation, or if you've got tax advisors, something I like to do is just do that little high level kind of corporation tax calculation. It's different from the sort of P&L model, but just to the side, and just sense check what the position's going to be. But there is going to be different things with dates here. So the dates that we're talking about, the years, and the interaction with any changes in legislation around R&D, tax credits and stuff is going to be very important. So getting all the facts out essentially and working through it, I think that's probably all I can add on that one.
We're now going to go into question 2. Just before we go into that, a quick reset of the conversation. I see there's some new people that have joined the live streams. This is Startup Finance's Q&A. It's our 9th monthly session. We run this every 3rd Friday of each month between 12 to 1 p.m., where myself and some amazing panelists who've been there and done it take to the stage to answer any questions you may have about your finances in the UK in terms of your business. That is obviously your startup. There are no wrong questions, and there's no need to be shy, as it's a learning curve for us all. You can ask us about anything to do with finances, whether that's cash flow, budgeting, profit and loss, payroll, employee benefits, taxation, bookkeeping, VAT, auditing, tax credits, loans, banking, fraud issues, projections, forecasting, and anything within that sphere, really. On the live streams, there's no point in trying to send me questions, because unfortunately we can't monitor any questions live, whether you're on LinkedIn, YouTube, Facebook, or Instagram. So if you do want to ask anything, you'll have to join us here on Microsoft Teams. Quickest way to do that is to go onto our website, startuptoscaleup.club. Again, startuptoscaleup.club. You will need to scroll down a little bit. You'll find today's session is Startup Finance's Q&A 09. It's a quick registration. Once you go there, basically click join, and it's a quick registration on Luma, and there you'll find today's link. Once you do that, simply come here onto our audio only Microsoft Teams call, and being audio only, by the way, means you can tune in from anywhere via any platform or device. And simply drop your question in the chat. We'll give you the mic, you introduce yourself, and then fire away with whatever question you have. Now, without further ado, we'll move on to the second question. That's an interesting one. So this is about allocating overheads across multiple product lines. So they're a health tech startup that work with wearable health monitors and subscription-based analytics. They're based in Exeter, recently started. The challenge is the company struggles to allocate shared overhead costs such as office rent and utilities across its hardware and software offerings. The situation is that their revenue generated seed funded with an expanding customer base. And then the question goes, as a health tech startup with both hardware and subscription-based analytics offerings, how can we accurately allocate shared overhead costs to reflect the true profitability of each product line? What UK-specific cost allocation methods, such as activity-based costing or standard overhead absorption rates, should we implement to ensure compliance with UK GAAP? Maybe one of the financial people and accountancy people here can help me with that. No idea what GAAP is, whilst improving pricing and operational decisions. If you've got any thoughts, please let me know. Maybe somebody can explain for me if you know what that GAAP stands for, please.
Yeah, it's just a standard UK accounting practice that most accountants tend to base their accounting on. But I would address that as well.
Thank you.
But it's a great question. You've got both hardware and software subscriptions, analytics. And I think the mistake is trying to split overheads evenly or guessing. That always distorts profitability of each profit line. The goal is to allocate overheads based on what actually drives the cost, right? So the first thing I do is start with two buckets of costs. You've got your direct costs. This is easy. This is your bills of materials, software hostings, etc. And then you've got your indirect overheads, the rent, utilities, and staff time as well. Now, the direct costs go straight into the product line, and overheads get allocated using a structured method, right? Now, going to what you said about the UK GAAP, right? Now, there's two methods. Usually you can manage this. And I know I'm speaking fast. It's only for time's sake. So if you get the opportunity to record this or to go back on a recording, please take notes on this and apply it to the business, right? So the first one, fantastic. So the first thing is activity-based costing, right? Some people refer to this as ABC. And this is great for startups with mixed physical and digital products. And what you do, you allocate overheads based on activities. So you've got stuff like engineering hours, customer support time, assembly time, data processing usage, right? And this gives you a very accurate picture of the real cost of supporting each product. The second one is the standard overhead absorption rate. And this is more traditional, but completely UK GAAP compliant. And you choose a sensible driver, for example, labor hours, machine hour, floor space, number of units produced. Then you calculate an overhead rate, right? It could be X amount per labor hour and apply it consistently. In short, I'm babbling a bit, but in short, use activity-based costings for accuracy and use absorption-based costing for GAAP compliance. Apply both consistently across your products, and you pretty much get a true picture of the profitability across hardware and analytics. I hope that did not go over your head. Contact me on LinkedIn if it did. I can explain this a little bit more to you if it helps. Thank you.
I'm definitely going to go back to this recording. Thank you, Samuel.
Yeah, that was a really good, quite a comprehensive kind of answer there. And I think just a bit I would stress on it is there's a good chance that you've got a very different method into how you allocate things for the management accounts that are used to, plan and to make decisions, and the accounts that you file with Companies House, which are going to be higher level potentially side, unless, if you're sort of obviously not at this stage, but if you're a much bigger company that had published accounts and things, that's going to be quite different. So I think the bit to be aware of at a smaller stage is making sure that it makes sense and you can make decisions from it. It's definitely look at, allocation methods, usage, square footage, etc. If it's salary based, I don't think we've mentioned people, but I think people is going to be a really big element of this, because I'm guessing you employ staff. So I would definitely be looking at that, working out, a sort of salary rate, maybe often based on sort of an hourly rate for your staff, and then being able to allocate that. Presumably they may or may not. I don't know if they're like, some people are working on hardware, some people are working on software, how you're set up, or if people are doing both. So you need to make sure that you also allocate that in the same way. And also probably just not getting too into the detail with it. You want it to be really clear so that people can step back and look at the different divisions and understand the profitability. But there's a danger maybe that you get too detailed. So you may still want an element of some overheads that are just the overheads of the business still in a lump at the bottom, and that you don't split down. So I think that it's just getting the right level of detail, that it's really clear what's where the profitability is, but it's that it's fit for purpose for the sort of decision makers. So hopefully that's helpful to add on.
Hi. Right. My advice is to keep this. I think that there's a lot of potential to overcomplicate this and spend a lot of time. As Harriet said, we're just going into too much detail. I think I've been doing this for 30 years and then worked with a lot of companies. And usually the reason you share overheads, and I mean like things like, if you're looking at all overheads, so think fixed stuff like the rent or the, even the CEO's salary, or that kind of things that are not going to change, whether you sell more software or hardware, it doesn't make a difference. It's there, to start splitting that out by product. To me, it feels a bit of a waste of time and not very productive. I'm not sure how much value that's going to bring. Know your true gross profit of your products. Absolutely. And if, and if you do have, if it's highly people based, then that, definitely, if you've got entire salaries with one type of product, then absolutely put that there, and allocate those by people. I think square footage and stuff like, usually that's reserved for, you're sharing a space with another company, but it's all one company. I would kind of keep some of those fixed overheads kind of separate. But if you're really intent on doing that, then I think, Samuel's explanations of those different methods are great to use. That's my advice.
Some very good points there, team. Question 3 for today. So this is about integrating payroll and accounting systems for their compliance, or to be compliant rather. So the startup is a fintech startup providing budgeting tools for gig economy workers. They're currently in Norwich. The challenge they have basically is that the company's payroll system operates separately from its accounting software, leading to discrepancies in financial reports and delayed RTI submissions. So again, somebody will need to explain what RTI means to me, please. The situation basically is that pre-revenue funded by Innovate UK and some angel investment. As a fintech startup managing payroll for a gig economy workforce, how can we integrate payroll and accounting systems to ensure accurate reporting and compliance with UK RTI and HMRC standards? What tools or processes, such as perhaps some API integrations or pre-built payroll modules, should we adopt to reconcile payroll data in real time and streamline tax submissions? I actually know let's call it an accounting firm / accounting software. I'm not going to mention their name, but really cool. And they've introduced AI agents for a lot of this kind of stuff.
So from what I understand, RTI stands for real time information, and it's something that it's like giving HMRC the payroll data that they need for each payday. So it's interesting. This is like, I like you mentioned AI agents. There's an integration and automation every week there's something new, and there's a lot of payroll providers out there, and hopefully, they should do all the work in terms of having that. If you have an external sorry, I'm just thinking, are they looking to bring this in-house? Is that what they're looking to do? Yeah, I mean, if you do use an
I have
external
a
payroll,
feeling that
yeah.
they're already in house. From
Oh,
what
they're
I can
already in-house.
looking at
Right.
the question, to me, it seems like it is in house. They may use various software, but it looks like they're doing it all themselves. But
Yeah.
again,
I always outsource payroll because outsourcing payroll is cheap and they know all the rules every time the rules change, and they do all the work, and all they give you is, they'll give you something you can just upload into your accounting system and it's done. So yeah, in terms of doing it in-house, the details for that, I'm gonna pass on that one, I'm afraid.
that's totally fine.
So I'm just picking up the piece that you've said that the payroll software is separate from the accounting software. Now that in itself is quite normal, because let's just say an example, you use Xero accounting software for your business. Xero payroll module, they have got one, but it's not brilliant if you've got a lot of staff. That's my personal opinion. You can process a lot of staff for it, but there's more specialist ones which are better for larger numbers of staff. That's quite a normal setup then to plug it into another system, and there shouldn't be a delay or a difference if it's sort of set up right, because you'll either have it in terms of the RTI submission, it should be going from the payroll software, and that's linked to your HMRC account, so it should be going there, so there shouldn't be any delay. Getting into your accounting software so you can reconcile it, that should either be going through the API if it's connected that way, or whoever's doing it should be journaling in the payroll journal if they are manual. And obviously we talked about AI assistance and various things, but there shouldn't be a significant delay in bringing all that data together, because certainly if you're doing monthly reporting, you're going to want to process payroll, make sure the data's in your figures for the month and be able to look at it. In terms of reconciling that, then that should be a case of as it happens, it reconciles. Obviously, you've got to make sure you've got people coded where you want them. But the moment I'm not totally sure. I mean, I make sure, I suppose, maybe the obvious one is that you are using a very legitimate payroll providing software that is compliant, and go into, whoever's doing it, go into the HMRC side and check that the filings are coming through. If you've got concerns they're not getting processed, maybe you need to have a log into the account and see if they're there. If you're outsourcing it, then this should be something that, if it's a reputable payroll provider, they should all be set up for you, and it should be functioning. I personally have had varying experiences with companies that outsource payroll, and sometimes you end up having to check it again and there might be mistakes, but it is something that obviously, the big firms that do it regularly. It's often something that your accountant will maybe do for you as well if you're outsourced. But I think initially I would point you to what is the software you're using, and does it appear to be something that's, compliant and reputable, etc. Who's in charge of the process, and do they understand payroll? Because as long as whoever's in charge of it is a professional in payroll, then they should be able to advise on all this and get it smooth and running effectively. So that's probably what I'd say. But I think there's possibly some bits of information we don't know about if you're doing it yourself, if someone in the team is having a go, or if you have engaged a firm but you're not totally sure if things are happening right. So I think that's probably the big question as well, that we don't know the information on. So hopefully that's a bit of a steer anyway.
Yeah, I would pretty much say very similar to what Harriet said. It's very common to have a different accounting software to your payroll. We were working with a client just this week, and they have a Bright Pay as a payroll, but they work from Xero. I was a bit confused about when they said discrepancy in data. I wasn't too sure, but I'm guessing, on a pay slip, on a payroll, you may get gross pay, you may get pensions, you may get student loans, but in an accounting software, all of that may just come out as a salary, which probably can be broken down a little bit more into what they actually are in terms of pension contributions, student loans, and so on and so forth, right? I think you can work around these things easily. You can break it down if you want to. But I think that, yes, there's many softwares out there that incorporate both your accounting and software. Xero, for example, does it. Sage, I believe, do it as well, that incorporate it. But I don't really think you need to now think about getting the same software. There are ways that you can work around or managing this process as well. And I think as well, when the payroll may also be processed, let's say on the 28th of each month, but it might only be withdrawn from the company bank account on the 30th, right? So these some kind of timings and things like that. But I don't think it's a major issue at all. And I think there's many ways you can work around it. Have a conversation with your accountant if you think it's a concern, but I don't think it's a major issue.
Let's go on to question 4, which might end up being our last question for today. This is about structuring compensation for pre-revenue startups. They're a biotech startup trying to develop plant-based pharmaceuticals near Manchester. Challenge: the founders have no revenue and limited cash reserves, making it extremely difficult to decide on compensation without jeopardizing operational sustainability. The situation basically is that they're pre-revenue bootstrapped with some early stage angel funding. The question he has is, as a biotech startup with limited cash reserves, how can we structure founder compensation to maintain operational sustainability whilst ensuring personal financial viability? What UK-specific options, such as low base salaries supplemented by dividends or the use of directors' loans accounts, should we consider to optimize cash flow and minimize tax liabilities whilst adhering to HMRC guidelines? Now, before I pass you on to the experts, this is obviously only personal experience. But if you are a business that is later going to go out there and try and get VC money or other institutional investments, in my experience, they tend to frown upon director loans and sometimes even dividends. So do bear that in mind. Again, this is only my personal experience. Accountants and other finance people in general, in my experience, again, they love this kind of stuff, but just as a caution, basically, that in my experience, VCs and other institutions tend to frown upon you getting into down the road of personal loans and director loans and dividends and so on. But anyway, let's hear from our amazing specialist. We'll start with Samuel. We'll go on to Sophie, and last but not least, Harriet. What would you do here?
So in a situation like this, the goal is to strike a balance between the founder survival and company survival. And so in a situation like this, you want compensation that protects cash flow, but also keeps you compliant with HMRC rules, right? So the first thing I'll do, many of us have heard of this, start with a low, consistent salary. I mentioned in terms at the start of today's webinar about the do's and don'ts, and don't treat your company like your personal bank account. And so what you need is regular salary, not just picking it when you want, regular small and consistent salary. Usually, what I recommend is between 8,000 and that way you don't pay any income tax on any of the salary that you pay. So it's compliant. You get your pay slip.
That's per year, Samuel, right?
Sorry, say that again?
Is that per year, annual?
Yes, annual. Sorry, not a month. Absolutely not. Right. So that's annually. So that's usually between like £700 and £1,000 a month for them. Also, we mentioned before, and I know something on this panel, and we discussed that we frown upon taking out dividends. Investors don't like it. But if you ever reach that point, only take it out when there are real profits, right? Not profits just on paper, but real profits that you can distribute small amounts. Because here we're talking specifically about survival. I will also be very careful about director's loan, handle director's loan with care. We mentioned about taking money out of the business as a loan, and it must be repaid back within 9 months, or you face a 32.5% section 455. So it's an interest that you're going to have to end up paying under. Other things you can consider as well, grant funding and investor funding as well. Yeah, I mean, in short, I think the best model is a small, consistent salary for compliance, no dividends unless you actually have profit that exists. Yeah, those are my bit of advice for this individual here. But yes, the reality is that you're not to strike that balance in a situation where you're trying to start something, especially an innovative idea. You will constantly and most times be wrestling between your personal income and the cash flow of the business. And it's one that just needs to be managed. But they are, especially as you're an innovative company as well, there are lots of funding out there that can assist you as well. I hope that helps. Thank you.
Thank you, Samuel. Ladies?
Hi. Yeah, I mean, I agree with everything Sam said. I see a lot of founders take 12 grand home, take advantage of the personal tax-free allowance and national insurance. Any other additional money they come in, it comes out of directors' loans, but then it moves into dividends as long as you can take it out of profit. It is very risky if you're unsure that you're going to have profits. If you don't think you're going to be profitable, don't do it, and you'd be better off just relying on the salary that you've decided on and that you can afford. I mean, obviously you need see what you can afford. If there's absolutely no revenue, by the way, it's going to be any of these kind of, no matter what you call it, whether it's dividends, director's loan, salary, you still need the cash to be able to pay it. Just make sure you can afford to pay whatever you're paying. But yeah, I would, if you're not profitable yet, stay clear of dividends and directors' loans, and just pay yourself what you can of what you can afford at a salary.
Pay yourself in IOUs. Thank you very much. And last but not least, Harriet, please.
So this is a conversation, I think that, it does, happen a lot. And I think the first conversation to have, I don't know how many we are, but it's obviously multiple founders, is an open conversation together to understand, be involved, and you may have already done this, I don't know, to be involved in this business. How much do you need to take? And it might be that some people have got other bits of work they do. I don't know if anyone else is consulting or in a job, or for whatever reason they've got their bills covered, and then somebody else might say, actually no, I need to pay my mortgage and I need to, to be involved in this, I need to bring a salary of X. So you need to work out the minimum that you all need in the early stages to be in part of this. And for example, then we'd start to think about, okay, so maybe somebody needs some salary, but somebody else is actually fine and they just want to make sure that they'll work for free effectively, but they, might come into their share of the share structure or whatever. That's important because for the business to be viable, as you mentioned, you need to make sure that people are not going to default on their mortgage or whatever, and they can focus on this. People may not have equal positions coming into this. Then I would look at, okay, you've mentioned you've got your pre-revenue, so there's no revenue coming in, but you've got some reserves, which I presume means you've either put money in yourselves, you've got a loan, you've otherwise come by some money to start this off, or perhaps I've missed something. Is there anything else? No, I think there's nothing that says exactly where it's from. That is really precious because you can use that in lots of different ways. And I would be starting to model, okay, if we were to put in these proposed salaries, how much money do we have? How long is it going to last? Is that then meaning we can get on and focus on building the business because we don't have to worry about money? Great, that's a good use of the money. You need to work out how long it's going to last you for and what else you need to spend money on. And then that may be a trade-off to say, well, actually, if we pay ourselves, we can't pay for whatever other costs we need to do to invest in it. I'd also look at when you're likely to go revenue because, to start generating revenue, because that's going to make a big difference then, because once you're generating revenue, perhaps that changes things. But I think the main thing is to have the conversation, document it, and note the differences in your own personal financial situations that may exist and how you're going to manage it in a fair way that means that you can keep going, but also being mindful that actually the business may not be able to pay you yet. I think that's all I've got to say for now, conscious of time as well.
Jeez, we're on fire today. Take that, financial confusion. Thank you very much. I would love to hear some parting words.
Have some kind of finance function from day one, and that doesn't mean hire someone or have a full department. Even if you're doing it yourself, just make sure you start to get a system, keep your records in order, know what's happening in your bank account, reconcile your bank account, do all of that from the beginning, because some people wait, or they'll register for VAT and do 3 months of bookkeeping the day before the VAT's due, or they'll do, so I've seen 6 months ago, okay, I started ages ago, and now I don't have any records, and you have to do 6 months it's a nightmare. You'll be so much more in control of your business if you just start actively facing your finances from day one.
I would just add, sometimes we think it's a tick list, do my cash flow, do my budget, do my forecast, etc. I'd invite you to keep things as iterative documents. So if you've got a cash flow document, make that a habit. You need to be updating things. In startups, things change very quickly. The things you thought a couple of months ago are not the case now. So make sure your financial, reports, cash flow, assumptions, budgets, all of the different things are live documents that you regularly go into, because otherwise they're very quickly out of date. And these are things, particularly a cash flow forecast, that is going to give you sanity. So you want to make sure you're on top of that. So yeah, otherwise, thank you for having me again, and always happy to connect on LinkedIn and follow up on any questions.
Thank you very much, everyone, for tuning in today. Really appreciate your time, but I especially appreciate our panelists who took time out of their busy days to come and help us for free today for an hour. A couple of quick things before my parting words. Just number one, we run 6 regular sessions helping startups hopefully go from startup to scale up, or helping founders rather. On Mondays, we take questions on talent. So hiring and keeping the right people. On Tuesdays, it's product and tech, so how to build your early stage. On Wednesdays, it's growth, so how to go to market and sell, basically. On Thursdays, it's fundraising, so how to raise investment or grants or whatever it may be. And on the second Friday of each month, it's UK startup law, how to protect and defend your business. And then on the third Friday of each month, as you can see today, it's UK startup finances, so how to make sense of your numbers and basically, hopefully, help you successfully manage your startup finances. They're all from 12 to 1 p.m. UK time. They're all available on our website, startuptoscaleup.club. Again, startuptoscaleup.club, and you can RSVP to future sessions that you prefer. When you're on our site, you may also want to join our WhatsApp community. We've got some amazing groups of founders, investors, operators, of course, our brilliant panelists and mentors as well. And yeah, that's in a nutshell. The second part is for those of you on the live streams, please do join us here on Microsoft Teams next time. And if you've got questions, rather than default to sending them because you might feel shy, or you think people will think differently of you, or you think people will want to steal ideas from you, none of that is going to happen. But one thing that is guaranteed to happen is that you'll get better answers from our amazing panelists. And let's be honest, it makes for a more interactive and better conversations anyway. So please feel free to join us here. Microsoft Teams, it's audio only, which means you can tune in from anywhere, via any platform or device. And it doesn't matter whether you're walking your dog in Surrey, or perhaps cooking or eating lunch in Liverpool, or maybe changing baby nappies in Glasgow, or working from a shared office in Cambridge. It really doesn't matter where you are, you can easily tune in. And now, as far as my parting words are concerned, just remember the startup journey can be both exciting but also quite challenging. So try to have some fun in the meantime, and be kind to yourself and everyone else for that matter too. Otherwise, have an amazing weekend and join us on Monday for Startup Talent Q&A at 12 o'clock. Thank you and God bless.